Hey, welcome back to Business 101, Introduction to Business. We are continuing our look at content from Chapter 3 of the text in this module number 3. And now in this fourth video, we're considering the third form of dominant business ownership in the United States, which you can see in the title slide. We're looking at the topic of corporations today. What is a corporation? We've probably heard a lot about corporations throughout our life. Corporations have been big employers here in the United States. Many of us, perhaps many of our parents and friends and relatives, have at one time or another worked at a corporation or are still working at a corporation. Corporations dominate the business news and business press, business newspapers and magazines. And so a lot has been said about corporations, but do we really understand how corporations contribute to the conversation about how to own a business? Remember, just as a point of review, we mentioned at the beginning of this chapter there are three primary ways to own a business here in the United States. As a legal entity, you can either be a sole proprietorship, a partnership, and there are several different flavors of partnerships as we mentioned, or a corporation, and that's what we're looking at today. A corporation is unlike either a sole proprietorship or a partnership in that ownership is sold by the business in shares of ownership, very small pieces, to multiple owners who are then, once they purchase a share of ownership, they're known as shareholders. Many times, this is known as owning stock in a company, especially in a publicly traded corporation where the stock is sold through a stock exchange. But even if the corporation is privately held, in other words, the shares of ownership aren't available on the open market, it's still a corporation with shares of ownership held by shareholders. Well, then who runs the business? Well, it's not necessarily the owners, because the owners may only own an infinitesimally small percentage of ownership. Rather, the business is run by professional managers, known as the officers of the corporation. This is where folks like the chief executive officer or the chief financial officer, etc. Sometimes we know those abbreviated by their acronyms, CEO, CFO. The chief officers are the officers who are actually the professional managers of the corporation. They run the day-to-day operations, and they are overseen in turn by a board of directors, and that's what that really means. Those folks who sit on the board, they are elected to sit on the board. They are the ones who have official oversight and management of the corporate officers. Now, one of the things about being an owner of a corporation, in other words, owning stock in the corporation, individual shareholders only risk what they paid for the shares that they own. And if the corporation goes out of business, goes bankrupt or whatever, if you lose anything, all you lose is the money that you spent to purchase the shares, which, of course, if a corporation goes out of business, the shares themselves are worthless, but you're not liable for the actual debts or liabilities of the corporation. Now, one of the things that is rarely talked about in quick conversations about corporations, well then, how do owners exercise control over this thing that they own? In other words, how do shareholders exercise ownership rights over a corporation if they're not running the day-to-day affairs, because the officers are? Well, it's because individual shareholders collectively are the ones who vote to elect the board of directors. Shareholders then, at least in theory, are responsible for choosing and selecting who sits on the board, who then is in charge of direct oversight of the officers of a corporation. Some other interesting salient points about a corporation is seen as its own living entity from a legal perspective, and therefore the corporation lives on after the owners retire, die, sell their shares to other owners. Remember, those owners, those shareholders, whatever happens with them, in one sense it doesn't really matter because the corporation lives on. It's its own special living from a legal perspective, living entity. Now, like partnerships, there are several different flavors of corporations. We see some of them there. The C Corp, the S Corp, the limited liability corporation. More on that in a subsequent slide. From here, what we'd like to do is show you a brief video regarding the basics of corporations. This is from the Business Roundtable. This may help to provide some basic understanding of corporate structure.
Recently, there's been a lot of talk about the role of corporations in our economy, but no one takes the time to explain exactly how they work or the benefits they provide. So let's give it a try. Corporations are designed to make a profit while delivering value to their shareholders, and by doing so, they drive economic growth and all the good things that come with it. And as corporations grow, many individuals invest directly or indirectly through mutual, pension, and retirement plans. These stockholders provide seed money or capital for corporations to grow, and in doing so, they create economic growth and reward investors with the opportunity to profit. In this video, we'll start with the basics of corporate structure, but be sure to check out later episodes where we'll dive into some of the specifics. Now, when you think about how a company runs, your first instinct may be to compare it to something like a school board or a homeowners association, or even Congress, where decisions are made by a simple majority vote. But corporations are more complex. In fact, there are three principal groups that govern corporations. They are the management, board of directors, and shareholders. Now, the relationship and responsibilities of these three groups are defined primarily by state law and a corporation's own charter and bylaws. That means each corporation is a little different, but all have government oversight. The management is made up of all those people with acronyms like CEO and CFO. Their responsibility is running the day-to-day operations of the company. Most importantly, management identifies and manages corporate risks. Now, the board of directors' responsibility is overseeing the strategy and performance of these guys and gals, the management. Within the board are various committees designed to tackle specific issues, such as audits, compensation, or corporate governance. Committees recommend policy for approval by the entire board. But we'll talk about this more in future episodes when we explain the inner workings of boards. The board of directors' main responsibility is to make decisions in the best interest of the corporation's shareholders, the people who voluntarily invest by buying stock. That's why they are commonly referred to as owners. Shareholders' piece of power is the right to elect these directors. They also approve mergers and acquisitions. And that's the structure of the corporation, employing millions of people in all sectors of the economy, providing health insurance and retirement plans, providing investment opportunities for all generations, and providing innovative products and services that affect every aspect of daily life. Be sure to check back for future episodes in this series, where we will continue to explore how corporations work and their role within the U.S. economy. See you soon.
Hope that was helpful. Let's keep going as we continue our look at the impact of corporations in the United States economy. As you can see from this next slide, we've mentioned this before, that far and away the majority of businesses in the United States are organized as sole proprietorships. That's what that pie chart on the left wants to show us, that 74% of businesses in the United States are actually sole proprietorships, but interestingly, over 80% of the actual sales revenues generated by businesses in the United States belong to corporations. And so, of course, as we mentioned in the video on sole proprietorships, a lot more numbers of them, but they're all much smaller businesses. And really, the large businesses commanding large percents of sales revenue of products and services, those belong to corporations. More on the corporate entity. As we've mentioned, the corporation is legally considered an entity separate from its owners, and therefore it's liable for its own debts. The owners, again, the shareholders, owners' liability extends only to the limits of their own investments. That is underscored by the legal status of the corporation as its own separate entity with its own indefinite lifespan, which ends up shielding the owners from legal liability for problems, challenges, lawsuits incurred by the corporation. The corporation possesses separate own property rights and the obligations that go with it, and is seen as a separate entity from a tax perspective. What are the advantages of organizing like a corporation? Well, the first and foremost is it shields owners from liability for the debts and liabilities of the business itself. Another very clear advantage is the lifespan continuity, that no matter what happens with owners or even a set of owners, the business continues as its own living entity. And of course, corporations with the ability to issue stock have a much larger and stronger fundraising capability to collect capital for larger projects. Disadvantages of corporations? Well, because of the separated management structure. Remember, we have this structure which is unique in corporations of owners, boards of directors, and management. Corporations can be taken over against the will of its own management, just depending on how you work the finances and how you purchase stock. There is also, on a technical level, double taxation of profits. What does that mean? Well, remember, we talked about the fact that corporation is seen as its own separate tax entity, which means any income made by the corporation is taxed by the federal government from corporate taxes. Then, when those profits after tax are paid to the individual shareholders in the form of dividends, that's also income to the individual owner, taxable on their personal individual tax return. And therefore, in concept, the profit that was earned by the corporation is taxed once at the corporate level and then again at the individual shareholder level. Probably the biggest disadvantage, however, of organizing as a corporation, it's really, really complicated and very expensive to form a corporation. You typically will need the help of a professional, like an attorney. You will need to file a significant number of forms, set up a charter, all sorts of paperwork, also very expensive to create and complete. And that's probably the biggest disadvantage of setting up as a corporation. It really does work if you are going to be around for a while and generate the level of business and revenues that makes it worth all of the upfront hassle and expense, but it's not a small thing to set up as a corporation. Now, this table is borrowed from your textbook, so I won't belabor the point here, but just to simply say what this shows is there are several different types, right? You see 6 of them listed there on the left-hand column, different types of corporations, each with their own set of distinguishing features and examples in the far right-hand corner. From the closely held, publicly held, subchapter S, limited liability, professional to multinational corporation, each of these has its own distinctive features. Let's see if we can chat about them quickly. All of this, of course, is also in your text. The closely held or private corporation, it is organized as a corporation, but the stock is held by only a few people and is not generally available for sale to the general public. There are many very successful private corporations out there in the business world. And that's contrasted, of course, with the publicly held corporation. You see it described there. A corporation whose stock is widely held and available for sale to the general public. And we have many well-known public corporations out there, from Apple to Amazon to General Motors to Ford to Pfizer Pharmaceutical to just there's lots and lots of publicly held corporations. You see the names of these companies on any typical stock exchange. Thirdly, there is the S corporation, a hybrid of a closely held corporation and a partnership, which is organized and operated like a corporation, but treated as a partnership for tax purposes. And clearly this is a target for very small companies, relatively speaking, who may want to have some of the advantages of a corporation, but still can get by being treated as a partnership for tax purposes. The second set of 3, limited liability corporations. It's a hybrid of a publicly held corporation and a partnership in which owners are taxed as partners, but they enjoy the benefits of limited liability, which is a little different than a professional corporation. You see that next, a form of ownership allowing professionals to take advantage of corporate benefits while granting them limited business liability and unlimited professional liability. Right? And then last, there's the very large multinational, or sometimes called a transnational corporation. It's a form of a corporation that spans national boundaries. You think of very large companies like, for instance, the world's largest food conglomerate, the Nestle Corporation, and those kinds of companies, very large multinationals. Now, some of the topics that we've discussed in the textbook that you should pay attention to: issues of corporate governance. And that is the discussion about the roles of shareholders, directors, and other managers in corporate decision-making and accountability. There has been a great deal of talk in the business press about some of the twists and turns in corporate governance and the influence of shared boards of directors and those kinds of things, right? You see some of the descriptions further down in the slide. I won't belabor them here. All that is information in the textbook. And so what I want to do now is just sort of pause to review what we've been talking about, right? What we've essentially said is there are three general forms of ownership in the United States. In this deck, we've been talking about corporations. And in previous lectures, we talked about sole proprietorships and different forms of partnerships. All of these together have different answers to questions about liability, management, who makes decisions, continuity when owners want to retire or when they die, who ponies up the money to start the company, and what do you get on behalf of your investment, all of those kinds of things. And so what we want to end with here then is a short video published by the John Deere Corporation to summarize some of the large contours and differences between these three dominant forms of business ownership here in the United States.
Deciding what kind of structure is right for you is a critical step in forming a new business. Since sole proprietorships, partnerships, corporations, and limited liability companies all have unique pros and cons when it comes to operating structure, registration, filing fees, liability, and taxation, which business structure you choose really depends on your personal circumstances and preferences. Let's start by taking a look at the sole proprietorship. A sole proprietorship has the simplest operating structure because it really only needs one person to make 100% of the decisions, you, the owner. Most states don't require sole proprietorships to formally register, which means you also won't have to pay filing fees. The sole proprietor may still be required to obtain special licenses or permits depending on their business. Because the owner is the only official in a sole proprietorship, they are liable for all obligations and debts. The owner is also taxed individually. Net business income or loss is combined with personal income and deductions and taxed at individual rates. That means you won't have access to the potential tax advantages of a corporation. The next business structure we'll look at is a partnership. A partnership requires, you guessed it, at least two partners. Partners are usually equally responsible for business decisions. However, if you have a limited partnership, one partner can be silent by contributing money without having any say in the company. It's recommended for partnerships to register with the Secretary of State's office and obtain all licenses and permits. Like a sole proprietorship, owners may be fully liable for all debts and obligations. And each partner is taxed individually through personal income tax. Now, forming a corporation can be a lot more complicated than starting a sole proprietorship or a partnership. However, the extra cost and effort can be worth it in the long run. A corporation must have directors to lead the company affairs and approve transactions, officers to oversee daily operations, and shareholders to have ownership in the company. However, in smaller corporations, it is legal for one person to act as the sole director, officer, and shareholder. To form a corporation, you must file articles of incorporation with the Secretary of State's office, which means you'll need to pay a registration fee. You'll also be required to obtain proper licenses and permits. Corporations must comply with more regulations and tax requirements because owners are generally protected from personal liability. Liability instead is placed solely on the business entity. Plus, corporations have access to tax credits that sole proprietorships and partnerships don't. And how you pay taxes is determined by whether you file as a C corporation or an S corporation. C corporations pay taxes at corporate income rates, and their shareholders are taxed personally for any distributions or dividends from the corporation. S corporations are pass-through entities, which means they are treated like sole proprietorships and partnerships and not taxed at the corporate level. There are limitations on what can classify as an S corporation, but most small businesses qualify. Finally, we have limited liability companies, or LLCs. LLCs give you the flexibility of a partnership and the protection of a corporation. The catch is, you can only form for a limited period of time. You'll have to register a unique business name in your state and obtain legal licenses and permits. And you must file articles of organization with your Secretary of State. It's not required to write an operating agreement, but it's recommended that you do, so you can adhere to clear rules and regulations. As the name suggests, a member's personal liability is limited when it comes to business decisions and actions. Generally, an LLC is taxed like a sole proprietorship or partnership, and income is passed through to the members as ordinary income. The LLC's members may select different tax treatment, however, so you should check with your tax advisor as to what your specific needs and options are. When it comes to forming your business, make sure to consider these criteria to see which structure works best for you. For further help, consult your financial advisor.
Well, I hope that was a good summary for you. It can really send your head spinning around. There's so much technical vocabulary and jargon and all sorts of different implications and consequences of decisions. There's a lot to keep track of when we talk about the topic of business ownership. There really is. So if your head is sort of spinning around right now, I understand, but you'll need to review this in the textbook. Remember, how a business chooses to organize its ownership has some pretty big implications and consequences on things like continuity, decision-making, liability of the owners, who makes decisions, what is the liability of exposure, all those kinds of things, right? And so these are very important decisions to take into account. Typically, business owners oftentimes make these only after getting advice from professionals. But so that you understand the concepts, it's important for you to take into account the kinds of things in this part of Chapter 3 and this video deck. Hope that helps. We'll see you in the next lecture.